Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And I thought it was sort of early August and things were supposed to be quiet right now.
Not at all. We have a global sell-off on our hands. It started in the U.S. last week, circled over to Asia, Europe, now back at home again.
And here we are back at home again. And with the biggest stories right now in the more than $13 trillion global ETF industry, one of them, of course, is that global sell-off persisting as tech leads the way with mega cap stocks sinking, Scarlett.
We're going to dig into how ETFs are being affected and their role in today's massive trading volume.
And amid all this volatility, earlier we spoke with Vanguard CEO Salim Ramji about his vision for the firm and whether he would take it public. As always, Eric Balchunas from Bloomberg Intelligence here with us now, looking at the flows. Eric, what is going on today?
Katie, Scarlett, it's one of those days, right? They happen, I don't know, it feels like every 9 months or so. It's just a bad day. Although it's getting a little better. You know, you see a little bounce off the lows there. I like to look at volume, right? Because ETF volume, especially for these big liquid giants like SPY and the Qs, a lot of institutions, the first thing they reach for to tweak their portfolio would be one of these ETFs. So the higher the volume, the more the fear. 33 billion is a lot. I won't lie. That's above the average of about 23, 24 billion. But it's still a little lower than like a true mass freak out level. I'll go over that in a minute. The Qs is high, TLT is high. All these are elevated, but not that crazy. The numbers here, negative 2.5. Again, bad, but it feels like it could be worse, right? And I like that TLT is up. You know, isn't it nice that bonds go up when stocks go down? We haven't seen that for a while, so that's good. You got some protection in treasuries there. Crypto getting the worst. I bit down 13%. Interesting to see. I think these are strong hands. We'll see if my theory proves right, because this is going to be a big test for those Bitcoin holders. Let's look at the volume of SPY historically, just so you can get an idea of this sort of fear gauge. So here we are today. You can see we're right above 40 billion, right? 33 billion since the day started. I look at 60 billion as sort of the freak out zone. So you can see like once or twice a year it goes above that. Now look at COVID over there. It had several days over 100 billion. So we're nowhere near that kind of a situation. And so I like to look at this as the thermometer. So I saw this as like a bad day, but not that bad. Let's look at also the returns of SPY. I think a lot of people get crazy on these days. It seems like everything's different now. But at the end of the day, these sell-offs are normal. SPY, since it came out in 1993, is up 1,000%. It was up a lot this year, way above historical averages. Sell-offs are pretty normal. And you can barely see some of these sell-offs over the years. It just keeps chugging higher. And that's a lot of the sentiment, Katie, that I'm hearing out there. There is a lot of freak out, but there's also a lot of pushback of like, hey, we were due, basically.
All right, Eric, thank you for that. Let's keep the conversation going now with Ben Johnson. He is head of client solutions over at Morningstar. And I want to talk about the ETF angle to this all. When you think about the ripple effects sort of to the fund complex, we know that there's still several inverse VIX ETFs that are out there. Think about what the actual VIX did today. It's calming down a little bit. Now we're at 33. We were above 60 for the first time in I don't even know how long earlier this morning. I mean, how are you thinking about the cascading effects here of what we're seeing in some of these market moves?
Well, I think what we see today, Katie, is what we've seen time and time again in the 30 plus years that ETFs have been in existence, which is ETFs are going to ETF. They're going to provide investors a common means, one ticker solutions for exposures from everything to the S&P 500. Eric was talking about SPY, to the VIX, to now crypto assets, you name it. So what we see in the market today is really what we've seen time and time again, especially in times of market stress, is that people use ETFs as an easy button, a place to find a buyer, to find a seller, to ultimately make prices and make markets more efficient, to trade assets back and forth in an easy, tidy, exchange-listed, low-cost, tax-efficient, convenient bundle. So ETFs are ETFing today the way they have been now for over 3 decades.
But, you know, within the ETF world, there's been a lot of innovation. There's now these leveraged single stock funds, also single sector ETFs that really allow people to bet unidirectionally in a big way. Are they exacerbating the sell-off? Because there's a lot of inflows going into names like NVDL or SOXL.
Yeah, it's a great question, Scarlett. And it's difficult to say whether or not that ETFs in this instance, these very niche single stock ETFs, are the proverbial tail that's wagging the dog, or if the tail is even attached to the dog for that matter. Ultimately, fundamentally, what we know is that it's investors' reactions, their opinions that are going to inform prices over the long term. Can we see short-term dislocations that are driven by impacts of things like new products, new ways of accessing and driving new money into or out of these individual names, it could very well be. But what we don't see anywhere right now is any clear smoking gun to provide us evidence that that is indeed the case, that the tail is wagging the dog, or in many cases, especially for broader ETFs, that the tail is even attached to the dog.
Ben, it's Eric here. I wanted to get your take on buffer ETFs and even the equity premium income ETFs like JEPI. These are both designed to help you on days like today, to help you sleep at night so when this kind of a day happens, you're not hit as hard. I'm curious Morningstar's take on these products. Do you think they serve a purpose in a portfolio, or do you guys generally stick to, hey, just use treasuries and other things to diversify?
Yeah, Eric, it's a great question. I think investors ultimately have to understand what it is they're signing up for and what they're giving up in the process. And generally with the buffer products in particular, what they're giving up in the process is participation in the long-term upside of equity markets, in particular when equity is the underlying of the buffer product. So if it helps you sleep better at night, that's great. But just know that over a long enough period of time, you're probably going to wind up leaving a lot on the table. So as is ever the case, investors need to know that they're going in to something and go into this with eyes wide open, know what they're getting, know what they're giving up in return. There's trade-offs in everything. And I think these buffer products, which effectively in my mind are just a kinder, gentler form of structured products now packaged in an ETF wrapper that are less costly, more liquid, and every bit as tax efficient, as traditional ETFs are expected to be, that nonetheless there are still trade-offs even in this kinder, gentler way of consuming structured product type outcomes.
Well, Ben, to that point that you're leaving a lot on the table if you're going into some of these buffered products and treating it like an equity allocation. I know that some of the issues that I've spoken to, and Bloomberg Intelligence as well, has thought about these sort of as bond replacement strategies, that, the allocation that you would be sending to the buffer ETFs, they would actually come out of what you would be putting into fixed income. I'm wondering what you think about that theory and whether it holds water with you.
That's been tried time and time again over the years, Katie, this sort of positioning. Like, let's get back to asset allocation basics. Cash is cash, bonds are bonds, stocks are stocks. Gold is gold, Bitcoin is Bitcoin. Bitcoin's not digital gold, cash are not bonds, bonds are not stocks. Never the two shall cross, and I think that's especially the case when you look at these buffered products. Now, while they're certainly potentially less volatile than traditional just full beta 1 equity exposure, the payout characteristics, the path-dependent returns, ultimately are something that investors need to take into account. They're their own unique animal that possess characteristics of a couple of different asset classes, ultimately by virtue of interjecting some option strategies into the mix. So these are their own animal and should be treated as such.
And Ben, private equity, on today's days like today, it tends to have better NAVs. It's a little more easier to stomach. So we've talked on the show about how people are trying to put private equity into the ETF wrapper. It doesn't seem possible. I agree with you. Interval funds might be the right spot for it, but interval funds are expensive. You guys show an average of 2.5%. Will that really take off? What's your take on this sort of, race to ETFize private equity?
Yeah, Eric, I think interval funds, there's 100 or two or so today. There's probably double that when you count the number of filings that have come across the SEC's desk just in recent months. The path of least resistance, I see it as to interjecting private assets into retail wealth portfolios. It's a format that is fundamentally very compatible with the way that advisors build portfolios today, their workflows, all the way down to tax reporting. You get a 1099 as opposed to a K1. So in terms of ease of use and in terms of the access to the investment opportunity set in the private space and private credit in particular, I think that's the path of least resistance. A path of, I would argue, more, if not most resistance is trying to wrap some of those same assets in an ETF. I think the assets are ultimately going to have to meet the ETFs where they are and where they need to be, which may take some form or another of tokenization. But one way or another, as you open up this asset class, these private assets, to more and more investors, my concern is, are they really going to deliver the goods? Is this ultimately going to pan out in a scenario where a lot of investors are signing up for what they hope is, an A12 Wagyu filet and getting something that looks more like ground up cow hooves?
Sounds delicious. What are you talking about?
Ben Johnson, what a great metaphor. Ben Johnson of Morningstar, thank you so much for joining us this morning. Now, coming up, our interview with Vanguard's new CEO, Salim Ramji, on whether he would ever take that firm public. This is ETF IQ on Bloomberg.
Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Let's take a look at this market right now, because what a sell-off we have on our hands. We're going to take a look at SPY right now. It's your biggest, oldest ETF. Of course, it tracks the S&P 500. You can see trying to claw back losses here. It was down 4.3% earlier in the day. Of course, that sell-off started in Japan. It came to the U.S., and right now, SPY currently off by about 2.2%. So not as bad as it was, but certainly not good. Let's also talk about Vanguard here, because I want to take a look at Vanguard's market share when it comes to overall U.S. ETF assets. You have Vanguard in blue, you have iShares in orange there, and you can see this is a story a decade in the making. Vanguard just taking share from BlackRock. I spoke to new Vanguard CEO Salim Ramji earlier today about what his vision for the firm is.
It's really been about two things. Certainly some of it is around what all are the new ways to serve clients or the new opportunities to deliver value to clients. And I hope and expect some of my external kind of experiences would help with that. But I will also say the majority of my interviews with the board, even coming into this role, were all about culture and the cultural fit. Because I think the first and most important thing is not just having a leader, but having a leadership team that really kind of advances the mission and the purpose that Bogle set out 49 years ago. And so it's those two things. But to answer your question around the future, look, some of it I'm learning and understanding. I think there's more to do outside the United States in terms of the opportunities in Europe. But I'm going to be spending some time there later this month and getting a firsthand view around that. I also think when you look at issues like retirement income, for boomers particularly who have accumulated really well with us over the years, but now need income and drawdown solutions, that's a really big deal. And even first-time investors, and getting people who might be investing in their late 20s or early 30s and would really be drawn to the type of proposition that we have, but maybe haven't heard of us in the way that I might have heard of Vanguard in my late 20s, early 30s. And so those are a few of the things, but a lot of it is really just listening and understanding where the opportunities are and what fits with Vanguard's culture and what fits with our ethos as well.
You think about one of the issues that seems to keep coming up for Vanguard. It seems to be quality around customer service. You've said that that's a priority,
Absolutely.
But I'm hoping that you can get a little bit more specific about how you plan on improving it, whether that's increased investments, are you hiring more? What's the actual plan to improve it?
So I've been spending a lot of time, Katie, in the past 4 weeks, just really listening to clients and understanding from them firsthand what they love about Vanguard and what they want us to improve about Vanguard.
Yeah.
And this is not just kind of large wealth managers or large kind of workplace kind of clients, but also individual investors and joining our advisors on the phones. And really understanding kind of each of that. So the first piece is make sure I've got all the facts and really hearing firsthand from our clients about both aspects of them. And there's a huge amount of loyalty, affection for Vanguard. And so that in moments where we let a client down, clients take it very personally, so do I, and so do all of us. I think the encouraging thing, as I've come to learn, is that starting about 3 years ago, we'd made some very significant investments in modernizing our technology to make things more cloud-based, to make things much, much more resilient. And I benefit from a lot of those infrastructure investments that have been made over the past few years.
When you look out into the future, could you ever see taking Vanguard public?
No.
No.
No, I would never do it. I don't even think it's possible.
And that was my interview with Vanguard CEO Salim Ramji earlier today. And the last question, would you ever consider an IPO? It was a short answer, Eric. It was just no.
Yeah, I was expecting that. People have asked me over the years as an analyst covering Vanguard, how come they don't go public? They've taken all the money. I'm like, it'd be the worst stock ever. Listen to this stat. Vanguard, while they do command about 27% of all fund assets, they only count for 6% of the industry revenue. It's because the people get all the money.
It is amazing.
If you're a shareholder of that stock, you won't get anything. I mean, it would be like bottom of the barrel stock. This is the whole point of the company, though, and I think he got to that. He's like, I think he called it genius. When I interviewed Bogle several times, I said, what's the bigger thing that powers Vanguard, the index fund or the mutual ownership structure? And he said, without a doubt, the mutual ownership structure, everything springs from that. So why would you mess with that?
It's a mutual ownership structure, but it is still a for-profit company. It's not a nonprofit.
Yeah, but the board is representing the investors. That's the key thing. So when it's almost like if all the Amazon customers were on the board, they would just say, hey, just make everything cheaper. And the shareholders would get nothing, right? So there are no shareholders, they're the actual investors. That has been a crucial difference between this company and the rest of asset management over the years.
Very much part of its identity, thanks to Jack Bogle. All right, still ahead, we're going to speak to Lisa Mantil of Goldman Sachs on hedge funds asking for help to launch ETFs. That's next.
This is Bloomberg ETF IQ. I'm Katie Greifeld, along with Scarlett Fu and Eric Balchunas, and we want to talk about Goldman Sachs ETF Accelerator. It's a platform that helps its clients launch, list, and manage their own funds without having to turn into a big issuer themselves. And joining us now, I'm pleased to say, is Lisa Mantil. She is global head of the Goldman Sachs ETF Accelerator program. And I just did my best to explain it, but maybe you could set the stage for us, because a lot of people call this a white label issuer. And I know that you over at Goldman Sachs don't actually do that.
Yeah, I think we should hire you as a salesperson, Katie. You need a new job? Yes. So Goldman Sachs ETF Accelerator is exactly what you said, right? It is a digital platform that allows any investment manager to more quickly and efficiently launch, list, and manage ETFs. And I think, where the idea came from was in 2019 when the ETF rule was introduced. I'll be honest, we were a little surprised at Goldman Sachs, which is the number of clients who are picking up the phone and calling the firm and basically saying the same thing, which was, we want to get into the active ETF market, but we don't know how to do it. And so that's where ETF Accelerator came from, those client conversations, that client demand. So what are we doing? We're taking our decades of ETF expertise, our risk management capabilities, and our very specific ETF technology, pulling it all together on a digital platform and exposing it to our clients for the very first time.
What is it that's going on at your clients that's prompting them to want to start offering ETFs?
Yeah, I think it's a lot of different things. I mean, you guys have spoken a lot about the generational wealth shift. I have a 20-year-old son. I'm telling you right now, he's not going to be buying anything that isn't exchange-traded, liquid, and transparent. So I think there's a generational shift, and I think there's also just this consistent drumbeat of managers wanting to be essentially wrapper agnostic. And so we have a lot of conversations with clients who want to get into the active ETF space, given the numbers that Eric talks about all the time and how the space is exploding, but it's still a really heavy lift to get into the space.
Yeah.
And so we are renting our people, so all that expertise, the playbook, the ETF playbook, and then all of that technology so that our clients aren't going to have a super long journey that takes months and months and months. You have to hire a lot of headcount, and it's a really big upfront expense. That's what we're trying to solve.
Yeah, no doubt. It makes sense to me. I want to go over one example. You guys work with GMO.
Yes.
They were, I would say, a little late. Recently they came out. They have a ETF quality QLTY.
Yes.
Is it $1 billion?
It is
Congrats.
on Friday. What an incredible milestone.
Yeah, that's a lot. It's hard.
They launched in November.
Yeah.
So November to August to get to $1 billion. You know how hard that is. It's
tremendous.
Is hard.
Yeah, no, it's top 1% of launches, basically.
For sure.
How does that work? How do you work with that company? And then when you get on a market, are you the one helping them get the billion, or is that on them?
That's on them. So from a distribution perspective, we do distribution support. We do a lot of education. We have full marketing resources as well. But I think GMO and a lot of our other clients, have that kind of same journey, which is they want to get into the active ETF market as quickly as they can. They realize there's an opportunity cost for not being in there. And it's back to what I was just saying. It's really hard. And so I think they made the decision as to, the other clients that we're working with to try to get to market quickly with less upfront cost.
And I know you can't talk about the pipeline specifically, but what types of clients are expressing interest right now, whether it be, institutions, whether it be hedge funds? Who are you speaking to right now?
Yeah, I think everyone is the answer, which is really fun, and it makes the job extremely challenging, but exciting as well. And so I would say a couple of things. When we launched this business, we thought it was going to be very asset manager specific. I would say it's still around 60% of the conversations we're having in the asset manager category. I will say top of mind for them, and I blame and or give you credit for this, Katie, is ETFs as a share class.
Right.
And so I think when you wrote that article a few months ago after ETF Exchange, that really ignited a lot of the conversations in the asset management segment, and that narrative has completely shifted. In January of this year, it was if the SEC allows ETF as a share class. Now it is when the SEC is going to do ETF as a share class.
How about crypto, whether it's Bitcoin or whether Ether? How big of a part of the conversation is that?
I'll be honest, it's been smaller. I think, what you will actually find interesting is the amount of hedge fund conversations that we're having. And I think that use case is actually fascinating because when you look at hedge funds, they spent so much time trying to figure out how to diversify their investment strategy, but little time figuring out how to diversify their investor base. And you couple that when you look at just the hedge fund data, hedge fund AUM over the last decade has basically stagnated at $3 to $3.5 trillion. So you take those two things together, and hedge fund managers are really asking themselves, what's the next evolution of their growth, and should they embrace perhaps the retail segment?
Well, Lisa, we have to keep this conversation going again soon. Up against the clock right now. Great to have you with us on set, too. That, of course, is Lisa Mantil of Goldman Sachs. And you can read all about this drill down, plus the latest in the ETF industry, if you subscribe to my weekly ETF IQ newsletter, Bloomberg.com/ETFs.
What a shameless plug.
I know, that felt a little self-indulgent, but in any case.
But go with it, go with it.
That does it for Bloomberg ETF IQ. I'm Katie Greifeld, along with Scarlett Fu, and Eric Balchunas. This is Bloomberg.